Students, so this video is to cover the basic concepts of the accountancy. So this video mainly the videos and going further videos mainly covers the syllabus for the 12th standards syllabus. So first is basic accounting for partnership for basic concepts. So let's just quickly go through what is the accounting principles and accounting related to the partnership firm, and what are the basic concepts of the partnership firm. Okay. So first is the nature of partnership firm. So what happens? What is the nature of the partnership firm? Partnership firm is formed only when there are two people involved. A single person cannot form a partnership firm. So there has to be two people. So first very condition to form a partnership firm is to have two or more people who join to set up a business. So the nature is there are two people and there is a business. Okay, so let's just quickly go through the features of the partnership firm. First feature is there are two people involved, two or more persons involved. Okay, so there are two or more persons. And second one is, if there are two people, they are agreeing to conduct a business. So the second condition, or not condition, second feature is there is an agreement between the two people. So the third feature of the partnership firm is there is a business. So the two or more people are agreeing to conduct a business. Okay, so the fourth is mutual agency. What do you mean by mutual agency? Each person is assigned to a separate role. There is an agency happening. Suppose one person agrees to act as an active partner involved in all the partnership firm matters, and the other person will agree only to invest in the capital and not involve in the partnership matters. So there is a mutual agency which is formed between the two partners. Okay, so next is sharing of profit. All the profits and losses during the year are shared between the partners equally or as agreed between the partners. Okay. The next is sharing of liability of the partner. Each partner will be liable for the whatever the debts or losses incurred in the partnership firm. So let's just quickly recall what are the basic features of a partnership firm. Okay. Of partnership firm. Okay, repeat after me. First is there are two or more people. Okay, and second one is there is an agreement between two or more people. What is the agreement? To conduct the business. Okay, and fourth one is there is a mutual agency between the partners, and fifth one is sharing of profits or losses. Okay, and the sixth one is liability between the partners. So these are the features of the partnership firm. So there are 6 features which you have to remember. This might come as a small 2 marks question for during the examination. So if you remember all this, you can write and get the 2 marks. Okay, so this is the features of the partnership firm. Next is partnership deed. So what do you mean by partnership deed? Partnership deed means when there is an agreement in writing is called a partnership deed. So the agreement may happen between two people, either in oral or written. So the two or more people may agree in oral to form a partnership firm or in a writing format. Writing format agreement is called partnership deed. So this is what it is written here. The agreement can either be oral. The Partnership Act does not require agreement must be in writing, but whatever is in writing, the document which contains terms of agreement is called partnership deed. And these are the contents of the partnership deed. You can just quickly remember 2-3 contents for the examination purpose. This is not much important, and just quickly go through the contents. Okay, name and address of the firm, name and address of the partners, amount of capital, accounting period, date of commencement of business, the partnership form, bank account, profit and loss ratio, rate of interest, auditor appointment, salaries, rights and duties. So all these are the contents of the partnership deed. This is not much important, so I'm not going in detail. So the next is provisions of Partnership Act relevant for accounting. So what are the Partnership Act which are relevant for accounting purpose? One is you have to know the profit sharing ratio, how much is the profit sharing ratio between the partners, okay, and what is the interest on capital, what is the interest on drawings, what is the interest on loan which is given by the firm or the partner, okay, what is the remuneration for the firm's work. So these are the provisions, these are all the basic requirements which we need to for the accounting purpose. We will go through in detail in the illustrations going further how to do the accounting treatment. Okay, so next is, so here there is a test your understanding. Mohan and Shyam state whether claim of partnership agreement is Mohan is an active partner. He is earning 110,000 per year. Shyam has advanced loan to firm. He claims 10% per annum. Mohan has contributed 20,000 and Shyam has contributed 50,000. Mohan wants equal share in profit. Shyam wants interest on capital credited to 6% per annum. Okay, so whether claim is valid, partnership agreement is silent. Okay, so if there is, if you want a salary, it has to be prescribed in the agreement. All this has to be prescribed in the agreement. So let's see, there is no answer for this, but all the conditions has to be prescribed in agreement. If there is no agreement, then there cannot be any claim for any interest or remuneration. Okay, so next is special aspects of partnership accounts. So what are the accounting treatment for partner capital account, profit and loss account, so all these are the practical aspects. We will do this in illustrations. Right now I am just going through quickly so that we will not waste much of the time. Next is maintenance of capital accounts. So capital account will be maintained either in fixed capital method or in the fluctuating capital method. Okay, I'll just tell the basic difference between fluctuating capital method and fixed capital method. Under fixed capital method there are two accounts, one is capital account and one is current account. Okay, so fixed capital means capital is always fixed, it's never changing. Suppose you are getting 10,000 to the firm, it will be 10,000. If you withdraw that, only those adjustments will be done in the capital account. If you withdraw capital or you introduce more capital, only those adjustments will be covered in the fixed capital method. And all the adjustments relating to interest, commission, drawing during the year, whatever the salary paid, all that will be covered in the current account. Okay, so next is fluctuating capital method. In fluctuating capital method, there is only one account, which is partner's capital account. In this, you will take capital account will take care of everything, drawing, salaries. So the going further illustrations, the question will specify whether the partners are maintaining fixed or fluctuating capital method. We will do the illustrations to understand in a better format. Okay, so next is distinction between fixed and fluctuating. How many accounts in fixed? Two accounts. Fluctuating, one account. Okay, capital and current account. Fluctuating, only capital account. Items relating to the drawing, everything will be adjusted in the current account, and here everything will be adjusted in the capital account. Next is fixed balance. Here it's remaining unchanged. Here every year it fluctuates. Credit balance. So capital account always show the credit balance. Capital means credit balance. Here it may sometime come to debit balance. Okay. Distribution of profits among the partners. It will be in the agreed ratio. Profit sharing ratio. Whatever is agreed between the partners, in that way it will be shared. profit and loss appropriation method, how the profits are distributed. So this is just an appropriation account. It has nothing to do with the expenses and income. So this also we will see in the illustrations. Okay, so this is, that's all my dear students. In the next video I will quickly cover the illustrations relating to the capital and capital method. Okay, thank you.